ladies and gentlemen, and welcome to Tattersalls and to this very interesting debate that we're about to partake in, I hope, and absorb today. We'd like you to take your seats so that catering can get underway, so that while a discussion of economics is taking place, it's not interrupted by too much clattering or chattering. Incidentally, just to introduce myself, I'm Glenn Taylor. For those who understandably wouldn't know who the heck I was, I am a former person on television. Sometimes I use the word personality, even if you're devoid of any such quantity. In my broadcast career, I started with the ABC, wonderful ABC, radio and television, and then I've worked for a succession of channels as a broadcast journalist in 9, 7 and 10, and then I ran out of channels. So enough about me. Let's get back to the tables. John McRobert, who for today's business is going to rechristen himself Jock, since we have two speakers who go by the name John, which will thoroughly confuse all of us. John welcomes you all, John McRobert, or Jock as he is today. And Jock has pointed out to me that on each of the tables there's a complimentary copy of his book, which discusses in fact two books, I think. Two books, which discuss the 2% tax idea. Now, the interesting thing is that John, you'll see on the back, that it's a very youthful looking John McRobert. You see there, he looks like about 25, but that was back in 1985 when he wrote the book. And it still has cogency today, and therefore is a reflection of his prescience and the strength of his argument that it can withstand a couple of decades of criticism and analysis beyond 1985. So congratulations to you, John. And it is an issue that John's had a passion for some considerable time, as you're no doubt aware. And he holds to his banner and holds to his perception and truth, and you're invited to fight over the two copies that are on the table. So he tells me they're complimentary, so you can share it among yourselves or maybe make arrangements to pass it on once you're ready. Take the phone numbers of those at your table and you can pass it on. So today we will be getting underway with the debate. Time is going to be tight. We have to clear the room just around 2 o'clock. So we want to get the most of things happening. So your meals will be served shortly. You will find bathrooms in the corridor just outside. The thing is to get the most out of this. So that's why I'm talking now, because we're going to get underway in about half an hour at 1 o'clock with, first of all, a protagonist, a speaker for the case, who will speak for 15 minutes precisely. There'll be a warning bell at 13 minutes, so don't alarm you, and then 2 minutes to round up. So there'll be 15 minutes from each speaker, then a rejoinder for 5 minutes by each speaker, and then we'll open it to the floor and questions from the floor if you wish. We will have a roving microphone available to let everyone hear what your question may be. The important thing when using a roving microphone is that you think of this as a torch, and the idea with this torch is to shine it on your teeth. If you do that, we will hear what you're saying, but if you do that, or if you do this, or if you do that, we hear nothing. So this is a torch, shine it on your teeth, and everyone will hear what you're saying. And also, this is being recorded televisually by Ian up here with his camera and sound system. And it's going to be on the ozfirst.net website very soon after, and it'll also be on the Free Matilda page of YouTube. So you'll be able to, if you go to YouTube and then click on the Free Matilda section, you'll be able to see the debate there. So I hope I've covered all the main points. I will be introducing the speakers, as I said, at around about 1 o'clock. Please enjoy your lunch. Thank you. Well, I can recall when I was studying Australian politics, back in my student days, that it was said of the upcoming new national government, when it was being promoted to the several Australian colonies of Australia, that this would cost nothing more than a dog licence. Well, all I can say is some dog, some licence, because it has certainly grown like Topsy ever since then. Some might even say a bit of a dog's breakfast, because now you've got tax law that goes into many, many volumes, reams of paper that you couldn't even put on one trolley, and most tax accountants are only specialists in particular areas of tax law because it is so vast, extensive and overwhelming. So really, anyone who comes along with an idea, however deviant or unusual it may seem, the one thing is that something's got to be better than what we presently have. So it's worth listening to what's being proposed. The questions, of course, arise about, well, is it practical? Is it practicable? Can we actually do it? We've presently got a government in power trying desperately to reduce tax by a matter of 2 or 3%, which is hamstrung by a vast Senate. My own view is the Senate should never have been increased to the number of members that it is today, because now anybody can get a seat in the Senate. Anyone with a vast extended family in Tasmania, for example, would satisfy the quota of getting a Senate seat. Initially, that was to have been the state's house with an equal number of representatives from all states. Just let me tell you, by comparison, in the United States, there's only 2 senators per state in a voting population of 150 million. We have 12 senators per state in a voting population of 20 million. No wonder the Kalamazumpians get a seat. You know? So governments are hamstrung, and we need to get something done, and that's what this is all about. It has to be realistic. I'm no economist, incidentally. My field of study was science in the realm of zoology and statistical maths. So, and then, of course, journalistic subjects in an arts degree. But I'm not an economist. So adjudicating would be terribly difficult. But we'll let you be the judges, and we'll let you show at the end of it all by your acclamation how you favour the speeches from our 2 Johns, our 2 speakers today. And so it is my great pleasure as your moderator. How can I be moderate? God, I'm an extremist. Okay, John Rivet, and it is pronounced Rivet, not Rivet. He doesn't have any French pretensions. John Rivet is our first speaker. He was born in Toowoomba, educated in Brisbane at Ironside State School, Brisbane Grammar and the University of Queensland, graduating with degrees in commerce and law and admitted to the bar in 1975. He studied economics in his commerce degree, earning a top 3 result out of over 200 in the income tax subject within the law faculty. Good on you, John. He's practiced as a barrister in Townsville, Brisbane and on the Sunshine Coast, taking on all types of cases in every court he could have appeared in. He's never wanted to develop a speciality, preferring the challenges of new laws and facts. However, he does have a passion in commercialising innovation and start-up businesses. Since he was 15, he started 22 businesses of his own, over 100 as a lawyer, and as a lawyer, consultant or independent director, and since 2001, invested in over 35 as an angel investor broker. Not all have been successful, obviously, so he's learned a lot about the risks in business the hard way. He currently practices as a solicitor and holds his own Australian Financial Services licence, which he uses to raise funding for new inventions and technologies. His sporting passions are rugby, cycling and swimming. On your bike, John, because you're coming up to here now, and swimming, and hobby is economics. So, ladies and gentlemen, without further ado, let's have a big hand for John Rivet.
Well, thank you very much for coming, and I see some old friends, and old friends are the best there are, so thank you. You've been such an appreciative audience. You've been invited on a trip to tax heaven, and there's an invitation on your table right now that has been delivered by the Archangel Gabriel. And if you look at it during the course of this debate, there's 2 of them that have got a number on the back. One's 50 and one's 100, and they win the lucky door prize to heaven. And the Archangel Jock McRobert will be donating a book to each of you at the end of this debate. So if you've got the 50 and the 100, keep it with you. That's 2 books. There's one for the 50 and one for the 100, and I'd like you to start now practicing mathematics. 1 and 1 is 2. This is a warm-up, because later on in this presentation you'll have to do some mathematics. And I mentioned the Archangel Gabriel. When I was a 12-year-old, I was a altar boy, believe it or not, at Christ Church, St Lucia, under the Reverend Charles, and he used to talk about the Archangel, and I thought he was saying the Archangel, and I thought this poor angel had a deformed thoracic spine. But if you're one of the 99% of taxpayers who have forgotten to declare some income or mistakenly claimed a few deductions which mightn't have been entirely legitimate, fear not. The trip we're making to tax heaven is not restricted to people who've been good and paid their tax, but it's totally a tax-free heaven. Think about that for a minute and how good that would be. You've been there for 1 week. After a week, as a guest of St Peter, a problem emerges on the Korean Peninsula. Tax heaven needs to get weapons, and they need to go weapons shopping in the USA, and the price has just gone up because the Saudis have bid them all up. So they need to buy fighter jets and some of the mother of all bombs. Quickly, the Archangel Gabriel discovers that Trump is overseas and there's a gap in Twitter. So he tweets off, "Tax heaven needs planes to bomb devil in North Korea. Tax coming." Your spiritual trip is about to be upset. So St Peter looks around for a system that he can adopt. He looks at the system in Australia, but there's too many compliance issues. There's too much cheating. There seems to be an attitude of compulsive defiance. And of course, all the tax inspectors and collectors are still living healthy, happy and long lives back on earth and are not available to help him in heaven. St Peter, thankfully, has read John McRobert's books, and he decides to impose a 2% tax. Gabriel tweets again, 2% tax coming, easy to understand, cheap to collect. Everyone pays 2% on the transfer of all goods, services and property. The seller receives the property, so they pay the tax. Sorry, the money. The seller receives the money, so they pay the tax. The heavenly boutiques in heaven are happy because all they have to do is print off the till tape. Pay 2% and that's it. How good would that be? Remember the catch cry. It's as easy as printing off the till tape. St Peter then takes a closer look at the Australian PAYE system and the GST regime and notices that the forms just need to be amended a little bit and he can use them in the 2% tax in tax heaven. Employers and sellers just fill out one form each month or each quarter, whatever the government wants, and they remit, in the case of sellers, the 2%. In the case of employers, they just pay 2% for their wages and salaries. Gabriel organises a copy of the forms and gets them sent up on the NBN. It took a few hours, but they finally got there. It's still nirvana. I bet you'd stay there if that was all that happened. What this parable shows is that starting from scratch, the 2% tax makes good common sense, and it's easy, and it needs to be explained in easy terms so that people can understand it. Seriously though, I do wish to thank Professor Quiggin for his good spirit in agreeing to this debate. It's a debate about economics, not politics, and I certainly acknowledge Derek Smith and John McRobert, who were the architects of this proposal in developing it, and on John McRobert for his 2 excellent books. I got introduced to this by my late father, and John would recall this story at the Mining and Minerals and Energy Club next door, where my father was hosting a table of about 10, and he wanted me to meet John McRobert. So he brought me along when I was a young barrister in Brisbane in about 86 or 7, I think it was, and at least I was younger than I am now. So my dad said, "This is John McRobert, I read his books, you should follow this up." I think he thought I was the futurist in the family. He was the engineer who was more interested in other more mundane things. But what he said was, he said to the whole table, "John," he said, "I loved reading your books." He says, "They're really excellent books. I keep them beside the bed, and every time I can't sleep, I read them and they put me back to sleep. But our aim is really to excite enough activity and enough interest in this to push the government or somebody to have this properly modelled. The tax system is broken. We all know that. There were two people who replied to this invitation. One was Don Billing, who's one of our more successful CEOs in our venture capital group. And he said, I can't come, but there certainly needs to be a better way to raise tax. The current system has more holes in it than a rabbit on the end of my shotgun. And then another one from Rose Sprinkard, who's an accountant, who replied to John, thanks for the invite. However, it's a crazy time at the moment. We're finishing off the 2016 tax returns. BAS is due on the 25th. Tax planning for 2017. All our clients want to talk about the super changes. I can't come. The fact is that in the current system, the biggest problem is that the wage and salary earners are the ones who are slugged. And this tax addresses that issue. This is the ABS report for the 2015-16 year, which sets out what revenue the governments have collected from us and what they've done with it. The first figure that is abhorrent is the tax on income in that year was $265 billion. That's the wages and salaries earners are paying $265 billion in tax out of a total Commonwealth revenue of $369 billion. That's two-thirds. Two-thirds of the tax in this country is paid by wage and salary earners. The businesses, 98 billion. There's something dreadfully wrong when that happens, and it needs to be addressed. There's a culture of defiance in this country, and I think it stems from our convict days or it stems from Eureka Stockade, but it's a culture of defiance. And interestingly, in the Australian yesterday, black economy surges to much larger than $50 billion. The black economy is nearly as big as the tax that the corporations in this country pay. Are we going to put up with that forever? On the weekend, I couldn't have got a better Australian newspaper to support what I'm saying in this debate. There's about 5 clippings which briefly say, banks fail to limit $300 billion levy. Chevron heads to High Court to fight against additional $300 million tax bill. Property investors will pay. Tax office crisis comes as super complexity meets its zenith. Technology giants paying 1% tax, not 1% of turnover, 1% of profit. That's all they pay. But the best one was one by Alan Kohler, who really is my hero. He said, as jobs vanish, we must tax differently. And what the thesis of his article is that in the present time, there's virtually zero wages growth. So when there's zero wages growth, there can't be bracket creep to collect more money for the government to pay its bills. The budget which was put down the other night assumes wages growth. Sorry, Mr. Morrison, that's probably not going to happen. And if that doesn't happen, then the budget will never get back into surplus, because you can't keep taxing people at the rate that it's going now if there's not, or you can't keep collecting more and more money if the wages aren't going up. So what Alan Kohler said was, this means higher GST and land taxes. There's simply no viable alternative. Well, there is, and this is it. But apart from endless deficits and perhaps coming to the unlikely global agreement on company tax, we have to tax consumption and wealth. And that's really what this is all about. The tax system needs to be changed. Capital is mobile. We all know that you can start a company in Singapore just as easily as you can start one in Mumbai, San Francisco, Hong Kong or Brisbane. And the capital can go wherever the lowest tax rate is. We are in a competitive world. We're trying to lower our tax rate for corporations, but it's still horrifically high compared with Singapore, Hong Kong, and Trump now wants to go down to 15%. We're dead. Dead in Asia. If he goes to 15%, all our startups will move to the US. Our children and grandchildren are on track to be a country of miners, farm labourers and rickshaw drivers in a sea of Asia-Pacific wealth. The answer is the 2% tax. It's been called various things. It's been called easy tax, transaction tax, spending tax, 2% tax. In deference to Derek Smith and John McRobert, let's call it the 2% tax. But a rose by any other name would smell as sweet. So it doesn't really matter what we call it. However, don't be confused. This is not anything to do with a bank debit tax. A lot of people get confused. So the attitude of the founders of this tax to the banks is don't make them the tax collector, because that'll give them even more power, and it's completely unnecessary to do it that way. So what this does, tweaks our current system. It doesn't introduce a system of bank debit tax. The simplest way to explain how this works is to understand the GST. And I'm assuming most of you would understand how the GST works in broad terms. What we do with the GST is we make 3 changes to it, that's all. 1, we reduce the rate from 10% to 2%. Simple. 2, we add it to property and labour as well as goods and services. And 3, we abolish input credits. That's it. That's all you've got to understand. So their 3 things are: the rates drop to 2%, it covers transfers of property, goods and services and labour, and there's no input credits. The abolition of input credits means that it taxes the transaction, not the value added, which is what GST tries to do. And it's vital to understand that the method of collecting this tax is already here. As St. Peter noticed from Tax Heaven, the forms which we use now for PAYE and for GST just have to be changed. And it's a reduction in the number of lines. The GST form now has about 16 lines. It needs 2. It says, how much did you sell? Here's 2%. How easy would that be? How wonderful. There are some concepts, though, we need to just run through. The first one is, when you're trying to understand this, focus on the new, not on the old. So try not to relate this to what happens now. Just look at it from the point of view of what could happen. And the small print and the method of introducing it will become obvious later. So focus on the new, not the old. Secondly, assume that every transaction is covered. Don't try looking for exemptions. Exemptions might come politically later, but they're not needed, they're not necessary, they're not desirable. So don't focus on exemptions. It only covers transfers. So if you're a saver and you get paid a salary and you put it all in the bank, you don't pay any tax. How good would that be? For once, savers rule. The one that's a little bit difficult is to say this, that under the new regime, take-home pay will become your gross pay. The tax that you get taxed on your salary is given to the government. It's not yours anyway. So take-home pay becomes the gross pay, and you go from there. The one thing that I need to cover in this section now is two concepts. One is cascading. When you have a tax like the GST and it taxes every stage of the input of goods and services into a manufacturing process, whatever you tax at each stage gets added on to the next stage and the next tax and so on. This is called cascading. Under the current system, the cascading is between 4 and 6%. It's about 2 to 3 times what it will be under the under the 2% tax. And the reason for that is that cascading through our whole cost of economy is primarily the tax on wages and salaries, which under this system will be abolished, remember, because the gross pay becomes the net pay, so there is no tax on wage and salaries, and the GST. Between the GST and the tax on wage and salaries, the cascading in our economy now is horrific. And with this tax, it will be a lot less. This is a good tax because it collects enough. It collects enough because there's so many transactions that are captured by this that are not there now. And they relate primarily, if you can understand this concept, to the transfer of wealth, which isn't taxed now at all. But it's at such a tiny rate, politically, it should be acceptable to most people, because if you tax a little bit of wealth when it transfers, then you can collect enough money. The second thing to say quickly is the argument against this is that it will cascade, and the fact is it will cascade, but it'll be a much smaller rate than under the current system. The second argument against it is what you call vertical integration, which means when you've got a business and you're selling your product to another business, then you merge together to avoid the tax. So the argument is that people will be motivated or incentivised to avoid the tax by merging the businesses together in a vertical integration. The point that puts an end to that is this. Under the present system, the cascading is between 2 and 3 times what it will be under the 2% tax. So there's no incentive now to do it. It doesn't happen. It's not a problem. So it'll be less of a problem under the new tax. Vertical integration is a very difficult concept to implement, and most people don't like it anyway, but it certainly is the fact that there will not be any greater incentive to vertically integrate under this system. Thank you.
John Rivett, who's given his first 15 minutes. He will be back. It's now my pleasure to introduce our speaker against the 2% tax, John Quiggin. He's an Australian Laureate Fellow in Economics at the University of Queensland, is prominent both as a research economist and as a commentator on Australian and international economic policy. He's a Fellow of the Econometric Society, the Academy of the Social Sciences in Australia, and many other learned societies and institutions. He's been an active contributor to Australian public debate in a wide range of media. He frequently comments on policy issues for radio and TV. He was one of the first Australian academics to present publications on a website. That's quite significant. It's now at the University of Queensland. In 2002, he commenced publication of a blog, now at johnquiggin.com, providing daily comments on a wide range of topics. He's produced over 1,500 publications, including 6 books and over 200 refereed journal articles in fields including decision theory, environmental economics, production economics, and tax policy. He's well qualified to speak to us, and we welcome John Quiggin.
Well, thanks very much for having me to speak. I think there's a lot that John said that I agree with, and certainly the need for reform of the tax system is one of them, so I won't try and defend the existing tax system. Some of my ideas are in a book which might be a bit hard to find called Taxing Times, which was published in the late 1990s, but I probably should return to the topic at book length at some point. So a great deal I agreed with, but a disagreement, I think, on one central point that came at the end of the talk. As I'll explain, the transaction tax, in fact, has worse cascading effects than does the existing system. This has been demonstrated both in theory and experience, and for this reason, it will tend to advantage vertically integrated businesses at the expense of small businesses who have long production chains. So I'll just go through, though, set the scene a bit. So first, let's look at the current tax system, and we all know the problems with it, but it's also important to get the magnitudes. It takes 22% of GDP as revenue. Now that's important, as John said, because governments do things. They do a lot more than they did in 1900. They buy fighter planes, they pay old age pensions, they do all sorts of things. That costs 22% of GDP, and of course 22 is a lot more than 2. So we in saying we have a tax with a rate of 2%, it nonetheless has to match most of that 22 if it's going to completely replace GST and income tax. I'll talk about some of the options a bit later. And we have, I think, very much the same numbers that John gave you in terms of the total revenue, being the same statistical sources, I'm happy to say. So, a 2% tax on everything. Well, what does that mean? Well, first, a tax on the gross value of turnover, which essentially replaces the GST, as was explained. That you take the existing GST, but instead of netting out input credits as we do at present, you pay the tax on the entire value of the transaction. 2% on household incomes, which obviously would raise much less than personal income taxes. We all know that we're paying a lot more than 2% of our income in tax, whether we're individuals or own a company. And then real estate and financial transactions, which in my calculation will roughly replace a whole bunch of other taxes that currently exist and presumably would be abolished. So first, it's an old idea and not a new one. So most European countries had a tax exactly like this in the period before World War II, and they replaced it with what they called the value-added tax, what's called in Australia the GST. And they did so for precisely the reasons that have been mentioned, cascading and the advantaging of big business over small ones. So it's also important to look, if we're looking at the debate, last time either John McRobert or I contributed in book form was in the 90s before the GST. So we formerly had something called the wholesale sales tax, which some may remember, which had many of these same cascading properties because you paid you didn't pay it at the retail level, that was the big difference, but you paid the tax on your wholesale sales, but also all your suppliers paid the tax on the stuff they sold to you. So the wholesale sales tax was somewhere in between a true cascading turnover tax and a value-added tax in which you get a complete net input credit. Now, what's the difference? As is already explained, and we're in agreement on this, the crucial difference is it applies the whole value of sales, including the cost of inputs on which tax has already been paid. So what that means is you're paying taxes on taxes. I'll give a worked example shortly, but what we can see is you pay on everything you pay tax on everything you sell. That includes stuff you bought on which the supplier has paid tax, their suppliers have paid tax, and so on. The term cascade is standardly used to describe this kind of tax, and you can read any textbook on public finance and it will explain that a turnover tax has more cascading effect than any other kind of tax in existence. It allows a low rate because the same good is taxed many times on its way. In the case of a primary product from farm to household, tax is collected many times along the way, and that's why a 2% tax can collect a lot more than 2% of GDP. Again, just repeating what John explained, with the VAT or GST system, taxes already paid on the inputs are deducted from the liability of tax paid on the final sale. And again, we know those are the other lines on the GST form that most of us have to fill in, that we get that money back. There's a nice one saying, money that owes you, which I love to read, and very rare that they admit to owing us money, but they do give us money back. Of course, they collect substantially more. So, why does it matter? As I say, it does, and I'm going to go through this in more detail later because it is just the one crucial issue that arises. It's good for big companies that can supply their own inputs, so-called vertically integrated companies, not so good for small businesses with long supply chains, and therefore we will see more vertical integration. The other point, and the reason why Australia didn't use, one of the reasons why Australia and most English-speaking countries that came late to the value-added tax system, is that this tax falls much more heavily on goods than on services. If I do a consultancy job or something like that, 2% tax only once. If any kind of service is taxed only once at the final point of delivery, whereas a good is taxed many times over. So it favours services at the expense of goods, and this is also an important feature of the important difference. So I'm going to talk about a steak dinner. I was mentioning in a very small way we're involved in the beef cattle industry, and I certainly like a steak dinner, so I've experienced most of the stages of this process, and we can look at how much tax will be collected. Well, a typical story would be that your calf gets born, fortunately no tax there. When it's weaned, sold as a yearling, at the sales a 2% tax levied there. Then maybe fattened, the stores would be fattened, sold again, another 2% tax levied on the entire price of the store. And in the meantime, of course, the feed lot is paying tax on feed, on all the other inputs. So there's taxes, more taxes as well as the tax on the actual cow that you bought. The meat work buys it, pays, there's 2% there, and also, of course, taxes on trucking, auction costs, so forth, another 2% levied on that value of the transaction. Sold to a wholesaler, another 2%. Sold to a restaurant perhaps, 2% more with that nice provenance that you get at nice restaurants these days. And finally sold to you at the table, another 2% levied there. And I looked at John McRoberts' evidence to the Senate back in the 90s, and I think I'm correct, I'm happy to be corrected on this. The estimate was that you would get 7 lots of 2%, around 14% in total. You have to get a number more or less like that because otherwise you're not going to replace the revenue of the GST at 10%, let alone the other taxes that we're looking at. What about a big restaurant chain? Supposing I'm a big multinational restaurant chain, a number of those have integrated all the way back to the farm, they own their own farms, they have their own drivers, of course, to transport things, They have feedlots. Probably they buy the grain for the feedlots. I don't think even the most vertically integrated grow their own wheat, but they from the moment the calf is born to the moment it appears in your hamburger, nearly everything appears within the same company. No transactions, no large transactions take place. They pay tax on some purchased inputs, but not much. And when they finally sell it, they pay the 2% on the entire product just once. So the total tax in this case is much less than 2%. Remember that we're replacing a 10% tax, so we have to have some people paying more than 10 to offset the fact that these people are paying only about 2. The implication, which is crucial, is that the big restaurant chain is going to be at a big advantage over the chain of small businesses that are involved in delivering a non-chain restaurant meals to you. Also services. As I've mentioned, services only pay 2%. There's no, when you deliver a service, there's no supply chain at which the tax can be levied. You just provide the service, and that's where the tax is paid. And of course, the service sector of the economy is already the majority of the economy and growing all the time. So this is a fundamental problem. It's one of the reasons why the Australian government and all the governments in the English-speaking world, which didn't adopt the VAT system back in the 40s and 50s, switched to a goods and services tax in the 1990s. The only exception is the US, where they have state retail sales taxes typically levied at 6 to 10%. So let's now look at some numbers. So I've tried to. I agree definitely with John that a proper modelling effort is needed. I didn't have time to do a proper modelling effort in coming here, but I have got some ballpark numbers that I have reasonable confidence in. According to the ABS business indicators, the gross value of sales, excluding this measure excludes intra-company transactions in Australia, was about $2,700 billion, which is considerably more than GDP, about 1.7. That's the tax base for a standard turnover tax. But to illustrate what we could do, I've looked at the case. The ABS produces something called the input-output table, so they actually trace all the inputs that go into producing a good, even if they're transactions within a given corporation. So if you look at the state dinner, they'll tell you how much farm went into it, how much trucking went into it, how much other services went into it. You can work out from that, if you taxed everything at the industry level, as soon as it changed industries, what the tax base would be, and that's much more, around $5.9 trillion, which is a lot. But to collect this tax, you would have to peer inside the operations of every major company and say, you at this point you change from this industry to that industry, you have to pay tax. So it's quite a difficult concept to implement, but it is conceptually, arguably, the tax base for conceptually close to the tax base, the maximum tax base that you can get for a transaction-based tax. I've just mentioned household income, around 1,000 billion. Roughly speaking, households get about 2/3 of GDP. So what's the revenue? So the turnover tax, I'm assuming that we apply it only to actual transactions. We don't do the hypothetical exercise of levying tax on corporations according to the tax they would have paid if they weren't integrated. 2% of 2.7 trillion is 54 billion, which is very similar to the existing GST. Importantly, John mentioned exemptions. The GST has some big exemptions. Food, or at least fresh food, is exempted. Health and education are exempted. This is the entire. This calculation assumes there are no exemptions at all. Also assumes it's perfectly effective. If you look at the total amount people spend as a sort of rough guide to what the GST ought to raise, you find that not everything that should be collected is being collected. Well, I don't think that will surprise any of us. Here I've assumed that nobody tries to avoid this 2% tax at all. I say the other taxes would roughly cancel out, and that leaves us with the tax on income. And as John mentioned, the notion is that tax on income will go down drastically. Of course, what that also means is revenue from income tax goes down drastically. In fact, it virtually disappears. So, could we do this? Well, I sort of thought, presumably we're thinking, 2 minutes? No, I'm in good shape for that, I think. Presumably we're thinking that there's a fair bit of waste, inefficiency, etc. in government. But I'm going to pitch a big number, a 50 billion a year cut. Suppose we cut 50 billion a year off. Now, looking at the last budget that tried to do cuts, that was in 2014. The biggest cut was 7 billion over 4 years to foreign aid. So roughly speaking, the biggest cut they got through was 2 billion a year. Most of the other cuts were too much to get through the Senate, as has already been mentioned. But we would need, for my 50 billion, which I'm allowing, we'd need massively more determination to cut all sorts of really tough stuff. Less fighter planes or less old age pensions. It couldn't be done just by trimming away the edges. Even so, we would have a deficit left over of about 200 billion a year. That would save 50 billion. There was about 20 million of coming in from the 2% tax. All the rest of the income tax revenue is missing. In that case, the debt would exceed that of Italy in 10 years, Greece in 15, and so forth. So in my view, that doesn't rule out the idea of easy tax. It just says if we're going to consider it, it can only be considered as a replacement for the GST. There's no way on these numbers that the easy tax can replace income tax. So we come to the question, which can be put in a different way, did all those countries that switched from a turnover tax to a VAT get it wrong, or did they get it right? In my view, they got it right. That is, the GST has its problems, and I'm sure none of us like paying it, but essentially levies a 10% tax on a very wide range of goods and services. The effective rates of tax under a 2% turnover tax would vary widely. Some people would pay more than 10%, some a lot less. In my view, the big gainers would be providers of services and big corporations. I don't see that that's an optimal way of going about things. And therefore, in my view, although easy tax sounds simple, it wouldn't in fact be the right kind of reform that we have. That said, I think it's important, given all the problems we have, to keep looking at options to change our tax system for the better, and so I welcome the opportunity to take part in this debate. Thank you.
Thank you, John Quiggin. Now we have a 5-minute rejoinder from each of the speakers, and firstly, 5 minutes from John Rivett. Thank you, John.
There are 3 points in 5 minutes. The first one is the GST works like this. The first stage of production, the person who sells that widget has to add 10%. The person pays that to the seller keeps it and gives it to the ATO. Then he's allowed to get back what GST the business has paid on the inputs into that widget. And there might be 5, there might be 7, there might be 10. So the mathematics, remember we said mathematics, the mathematics is that the 10% is paid to the government, then the business gets back the GST that they've paid on those inputs. But there's always a margin. The margin is the difference between the sale price and the sum total of the goods and services that are put into that stage of production. So it's completely incorrect to say that the GST only collects 10%. In my mathematics, it collects more, and it collects it because the last sale, the consumer pays the 10%, and believe me, they pay it, you pay it, we're paying it today, it's paid, so it's gone. It doesn't all go to the government because the last sale, in this case Tattersalls for the lunch, are able to claim back the GST on the input credits for the food and the wine. Okay, so the cascading effect of the GST is not 10% at the end, it's 10% at the end, but in every stage of production, there's a difference between what you pay and what you get back. And guess who gets that? The government. So when you look at 7 transactions in a GST chain, there's actually money going out to the government at every stage of production. That's one thing. But the really bad thing is that you don't get any input credits for wages and salaries. Remember, it's a GST on goods and services. So when you've got a manufacturing process and you employ staff, and staff is an average of about 13, I think it is, John, % of a cost of goods in an ordinary business, the wages and salaries are not taken off that value added because they're not in the goods and services tax regime. So every time there's a GST credit taken for the input credits. There's nothing taken off that margin for the wages and salaries. And worse, there's nothing taken off for the tax on the wages and salaries. So the margin is inflated. We were conned. John Howard conned us, and the Democrats wouldn't have known any difference. So the GST collects a lot more money in terms of that process than the revenue is there, to be sure, but it's a much higher rate and it's cascading at a much higher rate. So I say that the cascading effect at present is much, much higher than it would be with a 2% tax on each transaction because of the cascading effect of the falsehood that is represented as margin and the tax on wages and salaries and the salaries. The second point really is whether this will collect enough. The presentation John gives is all really based on income, and then he says, oh, well, the transactions to do with real estate and other properties even out what's happening now. My argument is they don't. My argument is that this is essentially a wealth tax on transfer of wealth. Let's be frank. Whether we can sell that politically or not, I don't know. But this is not an income tax. It's not based on GDP. It's not based on income. It's based on transfers of property. So not only will it collect money from the person who's spending out of their salary, but it collects 2% of all the transfers of property in the marketplace, which are not anything to do with income. They're historically held assets. So when you sell a $10 million house, you pay 2%. When you sell a $1 million house, you pay 2%. When you buy a speedboat, it's 2%. So there's all these transactions in the economy now which are not taxed at all, which will be taxed under this regime. And when the sums are done on that, the 2% tax actually will collect a lot more than is collected now. And Derek Smith's analysis says nearly 3 times as much. So the mathematics needs to be tested and need to be tried. So, and the final thing to say is that you've got to look at this from the point of view of what's going to happen with vertical integration. The figures in the proposal that John puts up is true. You know, in theory, there is an incentive to vertically integrate. My argument is, as I said before in my main submission to you, is that the end of that argument is that it's worse now. If I'm right, and it's worse now in terms of cascading, then there's more incentive now than there would be under the 2% tax for companies to vertically integrate. And I'm sure I'm right, but we need to test that. So if I am right, and if there is a greater incentive to vertically integrate now because of the cascading effect, then sorry, but it's nonsense to say that under this regime of 2% tax, it's going to be worse, because the mathematics can't be disproved, can't be wrong, in the sense that it's either worse or it's better. If it's worse now, then vertical integration is not a problem, because it isn't one now. But the other thing with vertical integration to say is that people can vertically integrate what you call forwards or backwards, or I prefer upstream and downstream. So the beef producer vertically integrates with the abattoir to become the one business. That's upstream. Or he vertically integrates with the supplier of the chemicals to grow pasture. That's downstream. Sometimes the vertical integration upstream makes sense. And if you look at the AA company, which has just set up an abattoir in Darwin, that's an upstreaming vertical integration, because they've set up an abattoir in Darwin when they're a cattle producer. The reason they do that is because they're an economically efficient cattle producer. There's no abattoir in Darwin, and they can give that abattoir continuity of supply. They would never have done it to save 2% tax. It just doesn't make sense. And the reason it doesn't make sense is because when you vertically integrate, you put two businesses together which are quite different. And you have to put a management structure over the top to run both businesses. Remember, you've got one business that's an abattoir, say, and one that's a cattle producer. If you put them together, you've then got to have a management structure over the top that manages the managers, because one company can't manage the other one and the other one can't manage the other one. So you end up with an overhead structure that would obliterate a 2% tax. And the final thing to say is this: vertical integration only ever works when there's price setters, not price takers, in the marketplace below you, in the sense that if you have competition amongst your suppliers in an economic sense, if there's competition for price and they're price takers, in other words, they haven't got the leverage to say that's my price and I'm going to take, you have to pay it. If you have got competition amongst the suppliers, then it never works for the business at the top to buy their suppliers out because they can never buy the cheapest supplier. It'd be a freak of nature if you could ever buy your cheapest supplier. And what I mean by that is if you're the abattoir and you've got 100 cattle suppliers and you say we're going to vertically integrate downstream and we're going to go backwards and buy a cattle property, it doesn't work because there's 99 other suppliers who will always potentially beat your subsidiary business on price. So it just doesn't work when there's a hard market below you. In other words, when there's a lot of suppliers and there's price competition, you're much better off playing the role of being the buyer and flogging around for the best price. That's how it works. And I have had some personal experience with this in the building industry, say, where if you're a commercial builder and you've got a factory that makes...
And we welcome back John Quiggin.
Thanks, John. Well, first, I mean, I think I like to find points of agreement, and John's absolutely right. The effective base of evaluated tax is the labour input. If you read any textbook on public finance, it will say that, in principle, there's a lot of steps hidden in that in principle. It's exactly the same as taxing labour income. So there's no doubt that that's a correct analysis. And of course, that works because the vast majority, the majority of income is labour income. So if governments want to raise revenue, there aren't that many places they can go. So that's entirely correct. The second point to make is, if you look at the GDP statistics, I mean, the number comes out every quarter of whether it's grown or not. But if you look at the way they're constructed in exactly the same way. That is, the GDP is taken by taking the value added in each sector of the economy, adding all those up, netting out the inputs in exactly the same way as the value-added tax works. And that means that we can, in fact, do a rough check on whether the effective tax rate is more than 10% or less. So GDP at the moment is about $1.8 trillion. The labour share of that is about $1 trillion, about 2/3. And a perfectly effective 10% tax would therefore raise around $100 billion a year. The GST actually raises $57 billion a year. So what that says is between exemptions that are deliberately built into the system, non-compliance, other bits of leakage, the GST considered as a tax on labour income is raising a fair bit less than 10%. So that's we can check those numbers if you want to go. The second point is one where debate isn't a great format. So I say VAT. I say that turnover tax cascades more. John says VAT cascades more. We both hopefully have convincing, clear voices. I can only say, read any text on public finance. There are lots of them, and they will all support my conclusion So if you want to check this, just go. I don't have a stack of textbooks here, but I can point you to them if anybody would be interested in looking at them. So those are really, I think, the only points I want to raise in response. I'll leave more time for questions. Thank you.
Well, thank you, Johns. You have your hands up for questions. Oh, I see, already. Okay, well, we now come to our questions session. I have here a roving microphone, which I better not turn on in front of this one. But as I said, just shine it. You're going to use that one?
Well, we have to use this one for the video.
All right. Can you put the two together?
Well, I'll try.
And that should work. There, that's now on. So we have a gentleman with his hand up at the back of the room here, at table 10. Thank you. Please keep your questions brief because we'll keep the answers. And to whom would you like to address your question? And we'll keep the answers brief to get as many as possible.
Hello. I stopped doing pure and applied maths in the early 70s, so I apologise for my complete ignorance. It seems to me that we're not seeing the wood for the trees. There is common ground between you two, but you're going to have to follow the idea. This might be the idea for the time that has come, not 20 years ago, 30, 40 years ago when you wrote it, John. You did agree that the tax take was, I think, 22% of something or other, and the tax take of the other one was 10% of something or other, and then there was another 14%, and we talked about vertical integration. I can only refer to the Australian last weekend, where vertical integration results in less than 1% of tax being paid by multinationals, Google, Facebook, Apple, eBay, etc. My request is to embrace change. All of the academics need to embrace change and keep up with Apple and Amazon and everybody else. And I think GDP is irrelevant, as I think one of the speakers made the point. There's a lot more transactions that are available in GDP. 2% mightn't be right, maybe it's 4%, but it's a damn sight simpler than what we've got now.
Well, I certainly endorse the view that academics need to take an active interest and look for change in a system which had plenty of its problems when we were writing 25 years ago, and where the emergence of companies like Apple and Google have created more problems. Nonetheless, I don't think that a turnover tax is the correct way to go. It may be that
My request is then model it.
well, as I say, yeah, that's true.
And at 4% and at 6%.
Well, as I say, I mean, I did present at least the outline numbers. The modelling, a more detailed model, I think, would produce the same kind of ballpark numbers.
Did you wish to respond?
Yeah. Just to say, with respect to the article, which I haven't read, I don't think it could be said that vertical integration causes those multinational corporations to not pay as much tax. What probably causes it is the fact that they're operating in a whole host of jurisdictions and they're getting taxed on income, not turnover. So this proposal, if it has validity, cures that problem. It cures it in this way, that presently a foreign company that operates in Australia can do one of two things. One is they can operate within the country as a registered foreign corporation, or they can operate under a wholly owned subsidiary. Most of them choose the former because they're then outside of the range of the Australian Tax Office. We should be saying you don't have a choice. You've got to operate as a wholly owned subsidiary and you've got to pay a turnover tax, because guess what? We have no hope of working out what their income is, given they're in 23 different tax havens. This tax cures the problem.
We have a question over here.
Thank you both speakers. John, I'm very interested in your 2% tax. I can't say that I ever really heard about it before. But do you really think that it is possible that it could bring in all the money that we spend in Australia? Or is it just a fancy idea that might not work or might work, but we're never going to find out anyway?
Okay, well, the answer to that is on a formulation of present incomes, no. Obviously, it wouldn't collect anywhere near what income tax collects, because when you look at the figures, the average tax is, say, 30%. If the average income was $100 million, the present tax would collect 30 million. If the turnover tax comes in, it would only collect 2 million. So obviously it doesn't work that way. But how it works is, it works on the other transactions which it picks up. And the modelling is needed to ascertain what the volume of those transactions is. But the logic of it, I think, that stands to real reason is this, that in the present time we're only taxing income, and we're taxing this value-added concept and some other things as well. But we're not taxing consumption or wealth, and particularly wealth. And unfortunately, we've reached the stage in our economy and our political system where we have to start taxing wealth. And taxing wealth means you tax people on their wealth or when they transact their wealth. And this proposal is to tax people when they transact their wealth, which will widen the area to prove that to raise enough money. That's the proposal.
Give money to your children? They'll leave it in your will, they've got to pay 2%?
I said at the beginning, don't worry about the exceptions.
If I could comment briefly, I mean, I think the big transfer of wealth, which is mentioned in the proposal, is transactions in real property, land and buildings. That's already, of course, taxed in all sorts of ways. Stamp duty, there's taxes on those things. There's a whole bunch of stamp duties you pay, as well as rates and other taxes. And so my calculation, I agree. I mean, I would claim it is modelling. It certainly isn't an elaborate computer model, but you don't need an elaborate computer model to get the answers right to within 10 or 20%. The answer, roughly speaking, is by the time we add all that stuff up, we're paying 2% on the average frequency of turnover taxes in land and property. The other examples John mentioned, speedboats and so forth, are already captured by the GST. The final case, which John correctly, I think, said we wouldn't have, is a 2% tax on all kinds of financial transactions every time you put money in the bank and take it out. We did have much smaller taxes of that kind in the past, and they were a problem. There is a case for a very low tax on the kind of massive financial manipulations that we see, but that's a very separate issue and wouldn't raise a vast amount of money. So it's my view, I agree, I focus the modelling on the important part, which is the turnover tax, but I'm pretty confident in the view that the wealth tax part of it, unless we had an annual tax on existing wealth, which would be a very big deal politically, wouldn't raise that much more revenue than the taxes it's supposed to replace.
We have a question from John.
Just a quick one. One of the huge problems faced by the Western world, especially Australia, I've got to look at this, especially Australia, is unemployment. We have 2 million under or unemployed people. If they were back in the workforce, putting into the public trough rather than taking from it, what a difference that would make. I'm not talking about a revenue neutral. You're talking about, is this going to equal that or is that going to equal that? I'm talking about doubling the size of the cake, having people produce instead of take, having people motivated. It'll be as easy to employ a person as to buy a pie. You employ him and you pay him. And that's it, instead of filling in all these forms. And
perhaps. Well, the question is yes, you're right, because this tax will make it so much easier to run a business and so much easier to employ people that employers would be more likely to do so. There's 2 points though. If you look at that article that I referred to in passing, which was the size of our cash economy at 50 billion, that's nearly as much as the GST that's going down the drain. And I need to answer that by saying that this system should be much better than that. I said in the speech we have a culture of defiance in this country. What we need is a culture of compliance in this country. And I think if people were only paying 2%, they'd be much more likely to comply. And that would, if we can do that, we could pick up $50 billion out of the cash economy. How that works is if you sell through the bank or through cash or through barter, you pay this tax. And if you cheat, you're going to have a problem because there's 1,000 unemployed tax officers looking for you.
Would you like to answer that?
Sure. Well, I mean, bear in mind, we all have seen the hidden economy or the black economy at work, but we can't collect the whole 50 billion. I mean, the average rate of tax is 20%. If we were at a perfectly effective system, we would collect 20% of 50 billion, which is 10 billion, which is a nice, handy sum of money, but is not going to solve the nation's fiscal problem. So it's certainly desirable to address that. There was a lot of talk that the GAT was going to fix it. I never believed that, and it didn't. But there isn't a huge sum of money to be had in, even if we could perfectly eliminate the hidden economy, which I don't think is possible. Looking at the more general question, would a big cut in the rate of tax you pay lead to a huge upsurge in economic growth and reduction in unemployment? This experiment's been tried in the US a couple of times, and the answer is pretty unequivocal, and we're seeing this right now in the budget debate. No serious economist believes that the big tax cuts that the current administration is proposing are going to deliver the kinds of economic growth that they estimate, which is still not enough to pay for the tax cuts.
We have a question here.
I just wondered
This one.
whether you said it's been introduced in New Mexico in the Spiel. How's it going there? In America, the same tax has been introduced already.
No, it hasn't been introduced already. They're modelling it.
Ah, okay.
So the senator there is modelling it. And the feeling amongst the internet press is that if it gets up there, every other state would have to adopt it for fear of losing their business to the New Mexico state.
Sorry, I apologise.
Thank you. My question is to Dr. Quiggin. The first speaker was described as an angel, so I'm not sure what you are. My question really is supplementary to the one asked by the first questioner, and it relates to jurisdiction. Doctor, in your opinion, will either GST or the 2% tax assist Australia to collect tax, relevant tax, from overseas suppliers like Google in this online economy?
Sure. So Google is a big problem. There's no doubt about that. And the structure, as was said, it isn't really vertical integration. It's something called transfer pricing, which is that they overcharge them within this vertically integrated structure. They overcharge themselves in such a way that most of the profits end up somewhere where they don't pay much tax, and so it goes on. And there's really, I think, two ways that are being looked at to address this. So the direct way, with plenty of problems but also some appeal, is indeed a turnover tax, but at a rate much higher than 2%. Remember that Google is paying GST on its sales. When Google sells advertising to an Australian company, they pay the 10%. So, and of course, we see ads for Australian companies in our Google searches because that's where we buy most of our goods. We'd need to levy it at a rate which not only captured the GST, but also the company tax that Google is dodging. The hard way, which is grinding its way through vast numbers of meetings in Paris and other places, is what's called an international agreement on base erosion and profit shifting, BEPS. If you Google BEPS, you'll find enough to put you to sleep, I guarantee, for the rest of your life. But all the OECD countries are busy trying to work out ways, because of course they're all faced with this problem, trying to work out ways of collecting this tax, while of course also trying to shift a bit of the revenue their way. So they're all, some more than others, are playing a double game here. But it is a big problem, a problem that's only going to get bigger. I don't think, though, a 2% tax is going to fix it.
Did you want to add to that, or do you want to take another question?
I'll take another one.
Take another question.
Yeah. For John Rivet. John, just a little comment and then a question. When we were facing the GFC, Kevin Rudd gave everybody $900, which was going to boost the economy. I would assume with the with your system and people only paying minimal income tax, it would be like getting that boost every month, which would have to be good for employment, because people would have more money to spend, and there'd be businesses would do better, and people would employ more people. The simple question I'd like to ask you was, if I worked for you and you paid me $100 under the 2% system, do I receive $98, or do you pay $102, give me the 100, and you pay the 2% tax?
The proposal is that the employer pays 2% above what he pays you. So, but bear in mind, if your salary now is $100,000 and you're paying $30,000 in tax, under this regime, your new income would be 70, because the tax is taken off. Now, how that happens is a mystery to most people, but in a free market economy, it would happen overnight, basically, except for the fact that there would be employment contracts which would lock people in. But essentially, if there were no employment contracts and if there were no awards, if you didn't work for 70, someone else would. So when the tax is taken off your wages and salary, suddenly you'll end up earning what you're taking home now. And then the employer pays the tax on that. That means you have your net tax that you had before. If we're right and there's an increase in spending power caused by this tax, everybody wins. In other words, if the prices come down substantially because of the drop in the cascade factor in all prices, then everybody will operate in a lower tax environment, which means a lower income tax environment, which means a lower price environment. So,
Thanks. Just very briefly on the fiscal stimulus idea. I mean, I'm a supporter of this view. It's not everything I've said up until now, I think just about any economist would agree with. This is something economists disagree about, but there are really two views. One is we shouldn't do it at all. The other, which is mine, is we should do it at times when the economy is facing a severe recession. If you just keep on pumping more money in year after year, the answer, which we know, is inflation. And so you can't just run deficits, you can't just print more money indefinitely and spend it without raising taxation. That I think is agreed by Keynesians and anti-Keynesians alike. So there certainly is a place for it in my view, but we can't get that stimulus time after time. There are reasons why it's difficult to push unemployment down below where it is, and a lot of that certainly has to do with the structure of the tax system, but in much more complicated ways than simply cutting tax across the board.
I think we'll have our final question here.
This one more there, this one more there.
Professor Quiggin, could you tell us, please, very quickly, yes or no, have you read both of John McRoberts' books with a pen in your hand?
I haven't read them with a pen in my hand. I have certainly looked at them, but I wrote my book quite some time ago, and a lot of, if you could read the books, a lot of them are statistics which are now kind of now outdated. I've also tried to find the details of the modelling that John commissioned in the 90s, but haven't yet been able to do that. So I'll be happy to take a look at that later.
Okay. Given that you haven't read both of his books, I wonder, could I ask you, please, as a favour to all of us, would you please read them critically with a pen in your hand and see whether in fact there is an obvious flaw that you can identify, and if you can't, and if in fact the figure ought to be 3% or 4% to make it work, could you please make that view available to the public?
Well, I mean, as I say, I think the flaw is well known because this isn't a new proposal. I don't need to read the exact details to tell you the numbers, and indeed I've done the numbers which say that, roughly speaking, the tax would replace the GST. If you wanted it to replace income tax as well, you'd have to look, off the top of my head, around 12%. Multiplying that by 7 is a tax going up to 84% on the transactions the most heavily affected. So my view is. This is the details of the proposal can be looked at, but the basic analysis is a proposal that's come up many times before, and the evidence from the data from the 1990s isn't going to change that. I'm prepared to have another look, but I won't. The answer will be the same. That's because it's in the logic of economics.
And we have a final question.
This question's for John Rivet. I like the idea of a flat rate consumption tax enormously, but in your example you just gave me there, I'm at loss to understand how you can, instead of getting $30,000 in tax to the government, you replace that with 2% of $70,000, which is $1,400. So where do we find the other $28,600 for the government?
Okay, well, the answer to that is in the tax on other transactions. And the other transactions include transactions which are not taxed at all now. For example, all goods and services, all property, all labour, which is the area, and basically all property would be what the difference is, I suppose. And that's where I think Professor Quiggin and I would argue that our argument is that there's enough transactions of property, and what I mean by property is not only real estate property, but any type of chattel, or even any type of what lawyers call shows in action, which means a right, say to occupy a residential tenancy or something like that. So there's a lot more transactions. Now what happens at the moment is, from the figures that we've both agreed on, and there's no argument, is that two-thirds of the tax collected by the federal government comes from incomes. Okay, under this proposal, probably 1/8 would come from the tax on wages and salaries. The other 7/8 would come from the transactions on goods and services and property. That's the difference. The question is, how much will it collect? Derek Smith models it as saying plenty. The professor says not so much. That's what we've got to model.
Sure. Well, just briefly replying, I mean, you really can do the maths fairly simply to say that the tax on goods, the tax on transactions of goods and services will raise about the same as the existing GST, no more. You can look at the 2% rate and then look at the range of taxes levied on land. The other goods and chattels and things mostly are subject to the GST. Certainly they're included in the tax base that I've used to estimate it. So I'm absolutely confident in saying that the tax, as described, will raise approximately enough to offset the GST and the property taxes it already replaces. The missing money that you describe is all missing.
Just one lady's question.
Yeah. A lady's question. No ladies have a question.
I find it quite mind-boggling, the whole thing. But the 7 million that was the 7 billion taken off foreign aid, for instance, is nothing. What we're looking at here is a fairer tax. And you answered that question, a fairer tax, because a lot of people don't pay any tax. Thank you.
Well, I may just say on that generous note of fairness, and we've been very fair, and it's wonderful that we can agree to differ, and in a forum like this, over lunch, most enjoyable. I'm rather horrified to see that in universities around the world at the moment there is an attitude of dismissal and shouting down anyone who has a countervailing point of view, and there is only one true gospel, which is a lunacy inside what is supposed to be a university open to all shades of opinion. But that's, as I read, it is happening. So I'd like you to put your hands together and show your appreciation for our two Johns, our two speakers. And on behalf of the other John McRobert, Jock, better known, I'd like to present you both with one of his publications. It's a rather marvellous book. It's a historical book on Australia's pearling industry. So there you are, each of you. Well, ladies and gentlemen, I trust you've enjoyed yourselves this lunchtime. It's been my pleasure to be with you. And keep your eye on the tax. Those who were persuaded by John Rivett, our first speaker, please show your hands. John Rivett, the first speaker. A goodly show of hands, indeed. And for John Quiggin. Well, there's an obvious bias in the room there. Well done, John Rivett, and thank you again, John Quiggin, for coming along and sharing your understanding with us.